Yeah, welcome to ShareTrek. First off, let me start by thanking SS, one of our subscribers from Japan, for reminding me why Japan avoids raising interest rates. Of course, I think SS has given one of the reasons, but there are a few more reasons that I would like to share, and then we'll get on with the rest of the morning show. SS says Japan has too many people who will struggle to pay their home mortgage if the central bank raises interest rate. So not only they can't raise interest rates, but they even keep negative interest rates here. I am Japanese, by the way. So that was a comment from SS. Thanks, SS, for your information and your support. I think that there are a few more reasons out there. One of them is the demographics. I think the demographics of Japan is not conducive at this point of time for economic expansion because there are fewer young peoples and more older peoples. And also the immigration system is a bit tight. So that could be one structural reason why this is happening. The second structural reason could also be because in order to maintain employment levels, there should be enough sales happening for those companies, and most of Japan's GDP is coming from exports. And if the Japanese yen became stronger with the increase in the interest rate, then the exports will become expensive. Even though the imports may turn out to be cheaper because of the stronger yen. But Japan imports most of the raw material that it needs in order to create all the goods that it exports. And these are all the complications that are behind the reasons why Japan is not able to raise its interest rate. Now, with that said, if anyone else has any other theories, please put in the comment. We're always happy to expand our knowledge and get more new theories in our place. And that said, today I want to share with you some of my thoughts around the current situation in the market, which has kept us in a bear trap for quite a while. I think if I was to give a title to this video today, it will be The Tale of Two Feds. So let's get started. Welcome back, friends. Now let's talk about the tale of two Feds. The first Fed is FedEx. FedEx has already said that it has seen a big drop in demand and is embarking on cost cutting. FedEx also said that they expected revenue to drop by $500 million. Why is FedEx so important? FedEx is important because as per stats available as on March 2021, market share for carriers shows FedEx with a 38% market share with the nearest competitor UPS at 26%. And the rest have much smaller shares with regional carriers at 16%, USPS at 9%, and DHL at 11%. It's notable that UPS does not share the same bleak outlook for rest of 2022 as FedEx believes. It is to be seen who is right. But we have to take a conservative approach when our own money is involved, so we'll assume that FedEx is right. However, when a major parcel delivery company says deliveries are dropping, then it means commerce is slowing down. Slowing commerce means we are progressing towards a drop in production, which is the loss of manufacturing jobs for the parts that are being shipped out, and services, loss of logistics jobs and jobs in service sector that have cut their purchases due to lower business volume. What I mean that, for example, is that if you have a, let us say, a hairdresser salon, and they have got fewer customers coming and they're going to ask for fewer supplies like hair gel and other things, right? For that matter, if you are going to look at someone who is creating picture frames and doing the job of framing pictures for their clients, they are going to order framing materials and glue and stuff like that. No, they're going to order much less because not many people are coming to buy the stuff. So I would consider FedEx to be a leading indicator of impending recession. The next Fed is the Federal Reserve, and in this basket, I would include all central banks worldwide, whether they call themselves as central bank or reserve bank or Federal Reserve. I'll put them all in one basket as the next Fed. The US Fed Reserve has already hiked 75 basis points to 3.25 and said that it will go on hiking until up to 4 to 4.25%. And with the inflation being somewhere around 8.5 to 9% ballpark, I don't think 4.25% is going to cut it. But these things, it's like turning around a huge ship. It takes some time. Therefore, there's always a chance that we may overplay the interest rate hikes, and as a result, we can slip into recession. Also, remember, quantitative tightening is happening in the US in parallel. It started in June, and every month there is increasing amount of quantitative tightening happening up. Neighboring Canada has also increased interest rates by 75 basis points with more in the pipeline. The US and Canadian rate hikes risk causing a housing crash. Reports indicate that the Canadian householder has much more strength and can weather this rate hike better than the US household because there has been a lot of controls put on mortgage lending in Canada, which makes sure that people who cannot afford will not be able to get a mortgage. So that's putting a lid there. At the same time, the result of that is the rental, the lease rates have gone up for residential properties in Canada, and it's become very expensive to rent a place. That is because people who had saved up in order to buy their own home are not able to buy their own home because they don't qualify under the tight mortgage rules of Canadian banks. And as a result of which, they are not moving out of their rental accommodation. And because of this, new migrants who come into the city or the country, immigrants who are coming into the country are not able to get a new rental stock, and this is pushing up the rental rates. And we have a situation where people are paying 1 year rent in advance in order to get a condo in downtown Toronto. So that's the situation we are in here right now. The Bank of England repeated last month hike of half a percentage point, taking rates to 2.25% from 1.75%. Over and above that, Britain is cutting taxes, saying they are likely in recession amid inflation of 9.9% and lowest unemployment in record. In Britain, the unemployment rate for May to July 2022 decreased by 0.2 percentage points on the quarter to 3.6%, the lowest rate since May to July 1974. I would say the lowest rate in recent history. I think this defies logic because recession results in higher unemployment, lower wages and incomes, and lost opportunities more generally. The data is not showing recession, so interest rates were hiked. That is the monetary policy side. While on the fiscal policy side, reducing taxes will lead to more disposable income, fueling inflation. This is bonkers in my opinion. Also remember, the new PM Liz Truss is on record saying that she wants to bring the interest rate setting into the political side. In other words, she wants to not only have the fiscal policy under her control, she also wants to have the interest rate policy under her control. At this stage, I would reduce exposure to any stocks in Britain because they have the Brexit related problems to handle, as well as exposure to Northern Ireland, where the border settlement is getting upended, with Brexit taking Northern Ireland out of EU, while the Republic of Ireland shares a border that will become non-compliant if EU border regulations were to be imposed now that Britain is out of Europe. This goes against the spirit of the Good Friday Agreement, and it's likely to cause a lot of problems out there. So Liz Truss has got a lot of things to handle, and this effort to get the interest rate setting to work against the fiscal policy, monetary policy going against the fiscal policy, I think that is bonkers. If any of you are watching this from Britain and if you have a different opinion, please educate me. Please put it in the comments below. I would always be happy to acknowledge that I'm wrong about something. This seems too blatant, so I might be mistaken. I stand corrected if any of you can give me good evidence. Finally, cutting taxes at this stage may also lead to weak government finances, and inflation that may further be fueled by this very tax cut is going to be a real problem for the monetary policy side. Earlier this month, Australia raised its interest rate by 50 basis points. India is poised to raise its interest rate by another 50 basis points. This means the world's Feds are mopping up liquidity. And if the liquidity gets mopped up, from a pure economic perspective, we can say that the amount of currency available in the world economy is shrinking rapidly. And the goods and services and the population remaining the same, it's going to make the money more valuable, which means that you're going to need less money to buy more stuff, which means we are pushing ourselves into a recessionary situation going forward. Because there's going to be unemployment, there's going to be a drop in production, there's going to be a drop in demand. And somewhere down the line, all the Feds will have to turn around and start reducing interest rates in order to stabilize the boat. This is going to happen sooner rather than later. And we don't know where the thin line is, and that's where in Britain there is the biggest conflict, because other Feds are all keeping a close watch on the economic indicators and are still stepping up on the interest rates to control the inflation at this point of time, whereas Britain is doing both the things together, On one end, it is raising the interest rates to control the inflation. On the other hand, it is cutting taxes and putting more money into the pocket of the household in order to be able to afford the inflated prices. So I think that is working on counter purpose. Now back to China. Due to the earlier Chinese policy of keeping exchange rate low to boost exports, we now have a situation where while the world is increasing interest rates, China is reducing interest rates to boost its economy. They have their own bag of problems to handle. We don't want to get into that. They have lent a lot of money under the Belt and Road Initiative and had their own companies doing infrastructure project using that same money for a bunch of countries, and those countries are already getting bankrupt. And so the problem for China again is whether they're going to continue building on the infrastructure project, or they're going to cut their losses and write off the loans that they have given to these countries. So it's remaining to be seen. And now let's not even talk about the Russia-Ukraine crisis and its impact on oil and gas and food inflation. So we'll set all those things aside. Just looking at this myth, I think that we are therefore in a bear channel on our way into a recession. I'll revise my opinion if any new information comes along to infuse some positive stimulus. And I would like to honestly hear from you guys. What do you guys think? And also I would request you to maybe a couple of hours later check our community section, because I'm going to put a poll out there to gauge the sentiment among our community regarding some of the factors that I spoke about. So please participate in that poll as well. And you can always put your comments below to educate me if I'm saying something that is totally wrong, but this is what it looks like to me. Now, I'd just like to take you briefly to the TradingView platform to see what the pre-market action is looking like. Suffice to say, it's a fool's errand to try to predict what's going to happen today, because there is extreme fear in the market, and we are generally in a bear channel. Any rally is going to be short-lived because it's going to go down again. So with that said, let's go to the TradingView platform. Guys, let's have a look at the Nasdaq futures here. Again, all these candles are one-day candles each. We are looking at the long-term view. And as I mentioned, we are in a very prolonged bear channel. And today already pre-market, we can see that Nasdaq futures are down 1.30%, which is not at all good. And we are at the very bottom. The MACD is absolutely bearish. We are very close to 30% on the RSI. Once we go below 30%, we have had instances on, let us say, on 26th of January, when we went way below 30%. So that's also a distinct possibility. Another possibility is that we'll go near it and we'll bounce back, have a minor rally, and then start our way back again. Either way, any rallies cannot be believed at this point of time, in my opinion. And now I'm going to go into the indicators. US oil is already down 3.48%. Friends, this is all flashing lights towards recession. Well, looking at QQQ, you can see that we are in this bear channel, which has got plenty of downward potential. If it chooses, it can come all the way down. And we have multiple levels of support. As I spoke yesterday, we have already gone past the support of 278.43, because right now we are at 276.67. So I'm going to mark this as a resistance. So it becomes a red line out here. I'm just going to thicken this red line so that you can see it in your smaller devices. And right now we are at 276.66, which is just above this line of support of 273.52. So that's going to be our first level of support today. And if you look at the MACD, it is bearish. Momentum is also down, and it's going towards the 30% mark on the RSI. S&P 500 is already down 1.21% pre-market. And again, the same conditions out here. IWM Russell Index is down 1.32% pre-market. It's fallen below the support line, which is at 172.14. So I'm going to mark this red. Again, I'm going to make this a little bit thick so that you can see it in your smaller device. Right now, we are just above our support at 166.19 for today. We are at 169.01. MACD and momentum all are looking absolutely bearish. Dow Jones Industrial Average is down 1.02% pre-market. We are on a very steep, very steep bear curve out here, bear channel out here. And our support, which was at 301.49, has now become a resistance for us, because we are right now at 297.44. And that is somewhere out here. So I'll have to draw some new lines of support. Please bear with me while I do that right now for you. I'm going to just roll this in sorry, roll this out a little bit. And we have a big gap out here, which we left before, and we are going to come back to fill this gap. So I'm going to draw a line of support out here, just above this gap. So this is going to be a line of support for us going down, and we'll have to watch what happens out here. And I think there's another level of support that I can put somewhere out here. So there are two lines of support. The first one is going to be at 292.70, and the second one is going to be somewhere around 285.74. That is my opinion on Dow Jones Industrial Average. And if I look at the VIX, VIX has spurted up. It has gone up 4.83% today, friends. There is good pickings out here. I think we have plenty of room for the VIX to go up. Look at the way the momentum looks. Look at the RSI. Absolutely bullish out here, which means it's totally negative for the stock market. And I'm looking at the US dollar index, which has gone up 0.51%. So for most of the developing countries and rest of the world, which are all buying oil denominated in US dollars and which have imports in US dollars, they are all going to import a whole whack of inflation. This is not at all good, my friends, not looking good. If I look at the index movers, Microsoft is down 1.15% pre-market, Google is down 1.11% pre-market, Apple is down 1.60% pre-market, Amazon is down 1.73% pre-market. Friends, I want you to look at Apple. Apple is still pretty strong compared to where it has been before, so it has not dropped much. However strong Apple might be, the indices have not yet fallen as much as they should because Apple is holding it up. Look at Amazon. Amazon has not fallen as much as it should. It should be somewhere down here. It still has got a long way to go. So Amazon is also likely to push down the index when it falls because Amazon and Apple have a large room for falling. If I look at Google, it has still not fallen much further, so it has got a lot of room to fall. And if I look at Microsoft, again, Microsoft has got a lot of room to fall. And if you go back and have a quick look at the QQQ has a lot of room to fall. It can come all the way down here, which just happened to be on 30th of March 2020, when we were somewhere around 180.30. Right now we are 276.58. So the risks are very high, my friends. And now if I look at crypto, with just a morbid curiosity out here, you can see Bitcoin has already gone to 18,941, and at some point of time it bounced off 18,637.9. I'm furiously trying to raise finances because I think Bitcoin can come as close as 16,527 before it goes up. So that's my opinion as it comes to Bitcoin. And if you look at commodities, the weakness is being shown in copper. Copper has gone down to 3.58. Wheat is still managed to get a marginal 0.34% hike, but this price of wheat is going to be under tremendous stress because countries that are paying in US dollars are going to find it very, very expensive. So we'll have wheat being denominated in other currencies and being sold in order to meet the requirements. Now, if you look at genomics, you can see that SQZ Biotech has fallen the biggest. I'm salivating at the opportunity to buy SQZ Biotech because when you look at the status of Apple and Microsoft and Google, the way I showed you there, Amazon, they have all not dropped to the bottom. If you look at companies like SQZ Biotech or most of our genomic companies, they're way below when they were founded. So those kind of companies have less scope of falling down further, whereas the companies which are influencing the index, the big ones, they have a more scope for falling. That's why you'll see weakness in the tech sector today. If we go to look at Invitae, it's also fallen down 6.64% pre-market. SQZ has got no trades. Caribou Biosciences fell 6.84% yesterday. Beam has fallen 2.43% pre-market. Allogene has gone up 0.37% pre-market, but I won't trust that unless there is some news. Let us see if there is any news on Allogene. There is no news on Allogene. PSCB has dropped 3.70% pre-market. Editas is down 1.43% pre-market. Intelia is down 2.77% pre-market. Bluebird, despite 2 FDA approvals, is down 3.35% pre-market. Teladoc down 2% pre-market. RG down 2.88% pre-market. CRISPR Therapeutics down 2.93% pre-market. Illumina has got no trades pre-market. And IMTX has got no trades pre-market. Verve has got no trades pre-market. DNA down 2.03% pre-market. Friends, the whole market is looking really, really bad. I don't think anything good is coming out of any of this thing in the near term. I'm just going to stay away from looking at my portfolio today. I'm going to try and see if I can cobble up some money in US dollars. I have a little money in my portfolio in the Canadian side that I can invest. I'm just going to hold on for it because I think further drops are ahead. As far as the US dollar side is concerned, I think I would like to liquidate some of my crypto and move over, because at this stage, I think equities present a much better risk-reward ratio as compared to the cryptos. So I have got Algorand, so I might liquidate Algorand. I have got Dogecoin. Where is Dogecoin out here? Dogecoin. I'll liquidate Dogecoin. Those two are positive today. And then I have got Solana. I have heavy loss on Solana, but I'm just going to take out the money, take all these US dollars, keep it handy to put into some biotech shares and some blue chips. That's my strategy. Whether I'll be able to pull it off or not is a different story, my friends. So that brings me to an end of this video. And I hope you liked this video. And despite the fact that the markets are bad and I'm giving you some kind of bad news here, if you like the video, please do not hesitate to put a like out there, because that will be the one good thing that I see today. Many people liking the video. That can make my day. And if you're not yet subscribed, please subscribe and let us inflate the subscriber numbers, because that's another good thing that is in our control and we can do. At least it will make my day better. So with that, my friends, I would like to bid you goodbye. Have a great day. Stay safe in the market. Don't do anything where you don't have 100% conviction. Go out and enjoy the day. Bye for now.